Stop everything and listen carefully, because what I'm about to share could completely change how you interpret the gold market right now. As of late March 2026, gold sits at $4,428 per ounce, down 21% from its record high of $5,596 set on January 29th. Over the past 48 hours, I've combed through vault flows, central bank disclosures, IMF filings, and London bullion market reports. What I found isn't what most people are being told. The common narrative is simple. Gold is falling because the dollar is strong and yields are high. While technically correct, this is dangerously incomplete. There's a second force at work, one that most institutional analysts following official sector flows recognized, but almost nobody has explained clearly to regular investors. This force is visible in IMF data, vault flow reports, and Bank of England filings. Without understanding it, you can't grasp why the upcoming reset, the one I'm calling the biggest, yet could trigger a move far larger than any event in this gold bull market so far. Not just larger than the current correction, but larger than anything that has come before it. Take Turkey as an example. Its central bank sold and swapped roughly 60 tons of gold, over $8 billion, in just 2 weeks following the outbreak of the Iran war. This wasn't a routine portfolio adjustment. It was a central bank being margin called by a war. Let me walk you through exactly what that means and why it matters for anyone holding gold, silver, or other precious metals today. The mechanism behind this is often misunderstood, so I'll break it down step by step. Turkey imports nearly 90% of its oil and 98% of its natural gas. When the Iran conflict began, Brent crude jumped from $75 to over $100 per barrel in just weeks, immediately inflating Turkey's annual energy import bill by roughly $20 billion. These contracts are priced in dollars, not lira, which meant Turkey needed dollars fast. The Turkish lira plummeted, hitting a record low against the dollar 11 times over 16 trading days after the conflict started. Inflation, already at 37%, threatened to accelerate, political stability was at risk, and the economy was close to fracturing. Faced with this, Turkey had 3 painful options. Option 1, allow the lira to collapse completely. That would have been political suicide. Option 2, burn through its dollar reserves, which were already dangerously low, making this alone insufficient. Option 3, sell gold, convert it to dollars, and use that to defend the currency, service energy contracts, and maintain enough stability to avoid social and political breakdown. Turkey chose the third option. Selling 60 tons in 2 weeks wasn't a strategic pivot on gold's long-term value. It was a forced liquidation, a sovereign margin call. Unlike a retail trader getting a call from a broker, this was a nation being compelled to sell gold to survive an energy crisis it didn't create. This matters for individual investors because most commentary focuses only on dollar strength and high yields. That explains mechanical suppression in gold prices, but the deeper, sustained sell-off comes from forced sovereign selling Turkey, Russia, and potentially others. You're seeing 2 separate forces in play: the structural headwinds of the dollar and yields, and the emergency-driven liquidation from central banks. Understanding both is critical to assessing whether this sell-off is temporary or structural. Turkey isn't alone. Russia's central bank began selling gold in 2025 to fund war expenditures, raising about $2.4 billion and reducing holdings to a 4-year low. Poland, which had been one of the world's most aggressive gold buyers, proposed monetizing roughly 550 tons for defense spending, around $13 billion. China paused purchases in late 2025, while India became a net seller in January 2026 to support the rupee. Put together, these actions represent the biggest buyers of the bull market from $1,800 to $5,596, shifting from net buyers to sellers or potential sellers. Most investors see this and panic. assuming central banks are abandoning gold and the bull market is over. That has historically been the wrong conclusion. Why? Because they're confusing forced selling with strategic selling. Margin calls are not policy shifts. They are temporary, crisis-driven actions with a predictable life cycle. Here's the critical question. If the central banks that drove gold to its all-time high are selling only because a war forced them to, what happens once the crisis stabilizes? History offers the answer. I've tracked 4 major gold market resets over the past 40 years. 1,976, 1,983, 2008, and 2013. Each followed the same pattern. Forced selling hit the market, not because institutions changed their strategic view of gold, but because they had no choice. Retail investors panicked and sold, deepening the price drop. Once the forced selling ended and crisis pressures eased, structural buyers returned, and the gold price surged past prior highs. The key takeaway: central banks forced to sell during a crisis do not abandon gold. They sell out of necessity, not philosophy. Once the crisis passes, they return to accumulating. The same logic applies today. The dollar demand and currency pressures driving Turkey, Russia, and Poland to sell are temporary, crisis-specific, and will abate once energy markets stabilize and geopolitical shocks normalize. The structural logic driving gold accumulation hasn't vanished. If anything, crises like the Iran war reinforce it. Energy importing nations now realize how vulnerable they are to dollar-denominated shocks. Gold, which cannot be frozen, printed, or sanctioned, becomes even more valuable when every other form of financial flexibility is stripped away. When the crisis subsides, these nations will buy gold again. Let's dig deeper into why this reset isn't just another routine market correction, but potentially the biggest yet. When I say reset, I'm referring to a very specific market behavior, one that has repeated with remarkable consistency over the last 40 years. In 1976, 1983, 2008, and 2013, the same pattern emerged. Central banks that had accumulated gold for years were suddenly forced to sell because of crises that drained their dollar inflows. Forced selling drove prices down significantly. Retail investors, seeing the decline, panicked and sold as well, amplifying the pressure. But once the forced selling exhausted itself, structural buyers returned, and the market rebounded sharply, often surpassing previous highs. Every time, the temporary dislocation created the setup for a much larger move. Now, apply that framework to today. Turkey's $8 billion sell-off is not a signal that the central bank has lost faith in gold. Russia's sales, Poland's proposals, India's rupee-driven selling, and China's pause are all forced or tactical decisions, not permanent strategic shifts. When the crises stabilize, the Iran war eases, oil prices moderate, and currencies stop free-falling, the same institutions that sold will resume accumulating. And the opportunity for accumulation is larger than ever because the temporary liquidation has temporarily reduced supply and created attractive prices. The scale of the current reset makes it fundamentally different from previous cycles. Consider the U.S. debt situation. In 1973, total national debt was roughly $500 billion. Today, it's $39 trillion. That's not a marginal increase. It's an entirely different order of magnitude. Servicing that debt at 4 and 5% interest rates is unsustainable indefinitely. Annual interest payments have exceeded $1 trillion for the first time in history, surpassing the defense budget, and this number compounds every year as older debt is refinanced at higher rates. These fiscal pressures are pushing central banks worldwide towards structural demand for gold, not away from it. Contrast this with the 1973 bull run. Back then, central banks weren't buying gold at scale. The infrastructure for sovereign accumulation barely existed in its modern form. Supply deficits in silver and other industrial metals weren't a concern, and technological demand drivers like AI, electric vehicles, and solar installations were non-existent. Today, gold and silver demand comes from both monetary and industrial pressures, making the market structurally stronger. Moreover, the global shift away from dollar-denominated reserves, what some call dollarization, has accelerated. Sovereign wealth funds and central banks from Brazil to Saudi Arabia to Indonesia are actively diversifying into gold. So, when we talk about the biggest reset yet, it's because this isn't simply a repeat of past cycles. The conditions are broader, deeper, and more geopolitically entrenched. Forced selling is just the surface level event. Underneath, the structural demand is immense and growing. When the temporary selling ends, the accumulation that follows will happen in a market that is fundamentally more constrained on supply and more motivated on demand than any previous reset. Understanding the three-phase playbook for this reset is crucial for positioning yourself effectively. Phase 1, which is happening right now, is forced liquidation. Gold is trading near $4,428 per ounce, down 21% from its all-time high. The current sellers, Turkey, Russia, Poland, are acting out of necessity. Turkey is defending its currency, Russia is funding a war, and Poland is evaluating defense spending. This selling is significant but finite. Countries can only sell what they hold. Turkey's potential additional sales are capped at roughly $30 billion, according to J.P. Morgan. What confirms we are still in phase 1. The Turkish central bank reported a drawdown of 58.4 tons across 2 weekly periods, 6 tons the week of March 13th, and 52.4 tons the week of March 20th. This rate of selling cannot continue indefinitely without depleting reserves to levels that would create a far more severe crisis than the one the selling currently aims to manage. Additionally, official data shows that Saudi Arabia's 323 tons of gold, the UAE's 11 tons, and Kuwait's 79 tons remain unchanged. Rumors of Gulf states selling may have influenced sentiment, but confirmed data indicates that actual physical supply hasn't been widely liquidated. Once the market realizes this, the fear premium embedded in prices will begin to unwind. Phase 2 is the stabilization phase. This begins when oil markets normalize and energy import pressures ease. Once the Strait of Hormuz disruption is absorbed, emergency dollar demand from energy importing nations, moderates, and oil moves toward $85, $95 per barrel. The marginal dollar demand forcing Turkey's hand diminishes. The lira stabilizes, forced selling slows, and the gold market recalibrates toward its structural price rather than the temporary crisis liquidation price. There's also a near-term catalyst for this phase: Russia's gold export ban, effective April 2026. This makes it illegal to export gold bars over 100 grams. Any Russian holder wanting to move assets internationally must sell before the ban. Once implemented, a significant source of near-term selling pressure will be removed, and a major gold-producing nation will be effectively locked out of the international market, tightening future supply. Phase 3 is the structural re-entry. Central banks that sold during the crisis begin to rebuild their positions. Sovereign institutions don't pivot instantly from selling to buying. They wait for crisis pressures to ease, for balance sheets to recover, and for the political environment to support strategic accumulation. Historically, this re-entry happens within 12-18 months of the reset start. China's accumulation program, paused briefly, remains intact. India's selling is temporary, driven by currency defense rather than a long-term strategic shift. Structural buyers have not left. They have merely been temporarily constrained. The key indicators I'm watching to identify when Phase 2 begins are straightforward. First, the Turkish lira. When the lira stabilizes and consecutive record lows stop, one of the largest forced sellers in this cycle approaches exhaustion. Second, Brent crude oil. Each week, Oil remains above $100, sustains emergency dollar demand, forcing gold liquidation. When oil falls toward $85, $90, the driver of forced selling moderates. These two indicators will tell us more about gold's path than commentary about the metal itself. Once we understand the mechanics behind the forced selling and the indicators signaling its exhaustion, the picture for gold's next move becomes much clearer. Institutional analysts have been closely monitoring this situation, and their conclusions are telling. J.P. Morgan, for example, raised its gold price target to $6,300 per ounce by the end of 2026, with an $8,000 upside scenario under certain monetary conditions. Importantly, these targets were set before Turkey's $8 billion sell-off and have not been withdrawn, despite gold falling from its all-time high of $5,596 to $4,428. Think about that. The most analytically rigorous teams on the planet are not reacting to forced liquidation as if it signals a structural change. They are seeing it as the setup for an accumulation opportunity, the precursor to what could be the largest move yet in this gold bull market. The pattern is consistent with every major reset I've studied over the past 40 years. Forced selling creates a temporary dislocation between the paper price and the structural price. Once the selling exhausts itself, the structural price reasserts itself fully. The underlying demand driving the original bull market never changes. It only pauses while crises force institutions to liquidate. Retail investors who panic during this phase lock in losses, missing the opportunity for the substantial recovery that follows. Those who recognize the distinction between forced liquidation and structural reversal benefit significantly. In every previous reset, the gains after the forced selling phase dwarfed the declines endured during the reset itself. Now, let's consider why the current reset could be even more impactful than those previous cycles. The scale of fiscal and structural pressures today is unprecedented. U.S. debt at $39 trillion, combined with annual interest payments exceeding $1 trillion, represents a financial load that was unimaginable in prior cycles. Central banks are forecast to purchase roughly 850 tons of gold in 2026, far above the pre-2020 average of 400-500 tons annually. Even accounting for the forced selling by Turkey, Russia, and Poland, the net official sector position remains in a strong accumulation posture. The strategic demand for gold has not disappeared. It has only been temporarily deferred. Industrial demand also amplifies the structural case. Unlike previous cycles, today's gold bull market benefits from technological and industrial drivers. AI infrastructure, electric vehicle production, and large-scale solar deployment are all increasing demand for gold, silver, and other precious metals. The 5-year silver supply deficit continues, with no viable supply response on the horizon. This inelastic industrial demand adds another layer of structural support for precious metals, ensuring that when forced selling ends, the rebound is supported by both monetary and industrial factors. Geopolitical shifts further reinforce this structural demand. The dollarization movement, countries diversifying away from dollar-denominated assets, remains strong. Developing nations, having absorbed the lesson from frozen Russian reserves in 2022, are restructuring their reserve holdings strategically. This is not a temporary response to one crisis. It's a permanent recalibration of how sovereign wealth is protected. Gold, with no counterparty risk, no ability to be printed or devalued by external authorities, and no geopolitical constraints on its availability, becomes the ultimate safe asset. Forced sales during crises, like Turkey's recent $8 billion liquidation, do not undermine this strategic logic. They reinforce it by highlighting the vulnerability of dollar-dependent reserves. Understanding these structural drivers sets the stage for the three-phase playbook I outlined earlier. Phase 1, the forced liquidation, is ongoing. Phase 2, stabilization, begins as energy markets normalize, emergency dollar demand subsides, and major selling slows. Phase 3, structural re-entry, will see central banks resuming accumulation, often within a 12-18-month window. The difference this time is scale. Forced selling is large but finite. Supply constraints are tighter, and structural demand is deeper than in any previous cycle. This combination primes the market for a potentially historic rebound. Let's examine some of the concrete numbers to understand the potential magnitude. Turkey's total gold holdings at the Bank of England were estimated at $135 billion, with approximately $30 billion potentially available for forced selling. The recent $8 billion sell-off represents a significant but finite portion of that. Russia's export ban coming in April 2026 will further restrict supply. Meanwhile, China continues its accumulation program, and India's recent sales are currency-driven rather than strategic. The combination of exhausted forced sellers, restricted supply, and returning buyers creates the conditions for a dramatic revaluation in gold's price. Another factor to consider is the psychological element of market resets. Forced selling often induces panic among retail investors, amplifying the price decline. Yet, historically, these periods are temporary. Once the selling pressure from sovereign institutions diminishes, retail sentiment often reverses, accelerating the price recovery. Those who can distinguish between temporary panic and structural demand gain a significant advantage. Recognizing that forced liquidation differs fundamentally from strategic abandonment is essential. It is this distinction that separates investors who capture the next leg up from those who are sidelined by fear. The current cycle is also unique in the context of energy-driven crises. Turkey's need to sell gold was triggered by an immediate increase in energy costs following the Iran conflict. Brent crude jumped from $75 to over $100 per barrel within weeks, sharply increasing Turkey's import bill. The lira plunged repeatedly, forcing central bank intervention. Once oil prices stabilize and the lira stops free falling, the emergency dollar demand driving forced sales diminishes. This combination of factors provides a clear exit point for Phase 1 and the onset of Phase 2. Watching the lira and Brent crude prices closely is critical for anticipating when forced selling will begin to abate and structural re-entry can start. Finally, consider the broader macro context. In 1973, the conditions for sovereign accumulation were limited. Today, they are expansive. Central banks are strategically positioned, industrial demand is rising, geopolitical diversification away from dollar assets is accelerating, and fiscal pressures are enormous. This creates a confluence of factors that make the post-reset accumulation phase potentially far larger than in any prior cycle. The current correction is a temporary, necessary clearing event, setting the stage for a major, structurally driven advance in gold prices. Now that we've laid out the structural dynamics and historical context, let's focus on what happens next in real time and why the upcoming moves could be unprecedented in scale. Phase 1, the forced liquidation, is nearing its natural conclusion. Turkey's central bank has already sold 60 tons. Russia's imminent export ban will lock in supply restrictions, and Poland is still weighing its decisions. These are all finite, crisis-driven actions. There is no infinite pool of gold to sell. As soon as these emergency pressures ease, the largest sellers in the current cycle will no longer be compelled to offload reserves, removing a major source of downward pressure. Phase 2, stabilization, is already on the horizon. The indicators to watch are clear: the Turkish lira and Brent crude oil. The lira has reached record lows multiple times since the conflict began. When it stabilizes, The emergency dollar demand driving Turkey's gold sales diminishes. Similarly, as oil prices settle toward the $85, $90 range, energy importing nations will no longer face a sudden cash crunch. Once both conditions are met, forced liquidation slows significantly, and the gold market begins recalibrating from its crisis price toward its structural value. The stabilization phase is essentially a bridge between the panic-driven lows and the strategic buying that will follow. Phase 3, structural re-entry, is when the real opportunity emerges. Historical precedent shows that central banks do not immediately pivot from forced selling to aggressive accumulation. They wait for the crisis to stabilize, for financial positions to recover, and for the political and economic environment to support a strategic return. But when they do return, the buying is powerful, often exceeding prior accumulation levels, because the temporary liquidation created an attractive entry point. China, for example, has not signaled a permanent reduction in its gold purchases. India's recent sales were driven by currency defense, not a shift in strategic allocation. These major institutional buyers are poised to resume accumulation once the crisis pressures subside. The forced liquidation has also created a favorable setup for retail and institutional investors who understand the pattern. Unlike past cycles, the structural demand base today is broader and deeper than ever before. Central banks are actively seeking gold, industrial demand is robust, geopolitical diversification continues to drive accumulation, and fiscal pressures in developed markets are extreme. When forced selling ends, these forces converge to create the conditions for a potentially historic bull run. The temporary decline should not be mistaken for a structural reversal. The floor forming in the $4,000, $4,500 range is not a ceiling, it is the launching pad. Let's revisit why this reset is larger than any prior reset. In 1973, U.S. debt was $500 billion. Today, it is $39 trillion, with annual interest payments surpassing $1 trillion. The scale of fiscal stress combined with elevated central bank purchasing power, ongoing industrial demand, and geopolitical shifts creates a structural backdrop that is unprecedented. Unlike previous cycles, the institutional infrastructure supporting sovereign gold accumulation is fully modernized, allowing for rapid re-entry once crisis conditions normalize. Additionally, the lessons from 2022, when Russia's foreign currency reserves were frozen, are still influencing sovereign reserve strategy worldwide. Countries now understand that geopolitical alignment can determine whether assets are accessible. Gold, immune to sanctions and freezing, remains the ultimate strategic reserve. Forced sales during crises, like Turkey's, reinforce rather than diminish this logic. When the crisis passes, the same central banks that sold under duress will return to aggressive accumulation, creating a structural rebound that far exceeds the current correction. For investors, the practical takeaway is clear. Monitor the key indicators: the Turkish lira's stabilization and Brent crude oil prices. These will signal the transition from Phase 1 to Phase 2. Once stabilization occurs, structural buyers will gradually re-enter the market, and the largest, sustained upward move in the current bull cycle will begin. Forced liquidation is temporary and finite. Structural accumulation is enduring and powerful. Understanding this distinction is crucial for making informed decisions and positioning effectively. Retail investors must avoid the common trap of panic selling. Those who hold through the forced liquidation phase historically capture gains that significantly exceed the losses endured. Selling during the reset locks in losses and sidelines investors during the recovery. The biggest reset yet is not the end of the bull market. It is the setup for the largest, most structurally supported move in gold prices we've ever seen. To summarize the three-phase playbook, Phase 1 is forced liquidation, finite and crisis-driven. Phase 2 is stabilization, as emergency pressures ease and market forces recalibrate. Phase 3 is structural re-entry, When central banks and strategic buyers return, driving a powerful, sustained rally. Watch the Turkish lira and Brent crude for confirmation of the shift. Once these indicators signal exhaustion of forced selling, the accumulation phase will accelerate and the gold market will reclaim its structural trajectory. In conclusion, the ongoing reset is not a sign that the bull market is over. It is a temporary, necessary clearing event, creating an exceptional buying opportunity. The floor forming now will act as the launch point for what could be the largest sustained move in this gold bull market. Forced liquidation has created a disconnect between paper price and structural value, but the underlying demand has not changed. The strategic rationale for gold remains intact across central banks, industrial users, and geopolitical actors. If this analysis gives you a clearer understanding of the current gold market, the finite nature of forced selling, and the opportunity it creates, consider subscribing to this channel. Each video is built on decades of observing these cycles and applying historical patterns to current events. Leave a comment below sharing whether you are holding, accumulating, or waiting on the sidelines, and what factors are influencing your decision. Sharing this insight with others holding gold or silver ensures they also understand the difference between temporary liquidation and structural reversal. The reset is happening now. The floor is forming. And the largest move yet in this gold bull market is directly ahead. Watch the Turkish lira, watch Brent crude, and prepare for a phase of strategic accumulation that will define the next chapter of this historic bull market. Understanding this mechanism now ensures you do not miss the opportunity that institutional investors are already anticipating.